Hello everybody, it's me the Boss Hog. I've had a couple of weeks over Easter, but I'm back. So we're going to be having a look at my stock portfolio as of the week ending the 29th of April, but really we've got 3 weeks to go through, so let's do it. Okay, so first of all, a bit of a catch up here. So between the 8th and the 22nd, you can see there it wasn't particularly great. And to be honest with you, the last week was a bit of a mixed bag. Honestly, until the US markets had a bit of a meltdown a couple of hours before close, I had thought I'd actually finished up, very fractionally on the week, but wasn't meant to be. It's extremely volatile. I'm sure everyone else has noticed, and just trying to navigate it as best as I can. Yeah. I am continuing to averaging quite hard. As I was speaking about earlier on in the calendar year, the new tax year in the UK starts April 6th, which means I've now got basically a very tax efficient account renewed to be contributing to. So basically I'm adding above my expected run rate of £800 a week at the moment. So we did 2,200 since we last spoke. And yeah, I'm basically happy about that. What can I say? Yeah, I'm just averaging in really hard. You'll see what I've been buying very shortly, but that's the current situation. There was also a reasonable amount of trading, although I only really sold from 3 positions, so I profit took on 2 of them, just reducing stakes. And actually, I sold out of one of my top 10 holdings entirely, having really just lost conviction and felt that there were better places to put my money. So yeah, I'll talk more about that shortly. Just the one dividend this week in a fairly quiet April, which is Redrow. This is my main UK house builder. I think honestly the whole UK house builder represents a good investment opportunity. You can basically pick whatever you want. I'm picking Redrow because it's going through a little bit of a business change in its focus. I think it's unlocking value as a result of that, and until then I'm happy to collect the dividend basically, and we go from there. So that's the summary. Let's have a look at how my top 10 are doing. It's not particularly great. All right, so I've added a change column here just so you can see movement week on week. Obviously this is compared to 3 weeks ago. So first of all, T-Row and Fever fallen out of my top 10. I'll touch more on those when we get to the sales slides. We do have a couple of new entries here, so we're going to just go through this nice and quickly. I'm going to start with National Express. They had what I would class as a reassuring update. Not really any surprises. Revenues back to 2019 levels. The bus market continues to be a little bit of a struggle for them, currently sort of less than 80% to 2019, but their business in the UK and Spain in particular, their coach business in the UK and Spain in particular is going really well, and their business and school coaches in America are starting to pick up as well, so that should be good. Not too many surprises. The company remains fully hedged in terms of fuel to 2023 or halfway through 2023, and it's sorting out this hedging position, so managing its risk as well as it can basically. And I think the market responded positively. I still think broadly speaking the market isn't giving it enough credit. I think it's like best in class, and I think it will continue to benefit, buy up small companies and go from there, expand basically. Gamma, no update, continues to be beaten down. I expect Gamma to become my largest holding over the next few months, just because I think it's a bargain at the moment. I really must get out a video explaining why I think it's a bargain, but that's my current position anyway. Also as well, for anyone who's new, I would say my top 10 can almost be broken down into 3 chunks. So first and second are like way out in front. You're talking like 15% of my portfolio each. Then numbers 3 to 7, you're looking at between sort of 7 and 9% of my portfolio each. And then there's quite a big drop at 8, 9, and 10. You're looking at about 2.5% of my portfolio each. So just to give you an idea of what that might look like. So next up we've got Games Workshop. Again, there's an article I'll put in the comments from Investors Chronicle, basically explaining why they remain bullish. It's kind of what I've spoken about before, but if you're interested in that, then go and have a read. Amcor are actually publishing results on the 2nd of May, so we'll keep an eye out for that. It's been kind of pulled down with the wider semiconductor pullback. I like it. I like their position in sort of the business cycle, where it sits. I think it's a company that's coming into its own and has now achieved scale, and is a good buying opportunity. So I'll be looking to add basically to Amcor. Next up, Hollywood Bowl. They did have a good jump a couple of weeks ago following a half-year trading update. Modest pullback. I have been taking some profit from Hollywood Bowl and redeploying it, but I think it's a very strong company, and I think it's although it's a consumer discretionary stock, which is of course under a lot of pressure, I think it's one of the best places to go for like a fun family day out, and Hollywood Bowl is by miles, I would say, in the UK, best in class. So a very strong company despite its relatively small market cap of about 400 million. Next up, we've got Phoenix. So there was also a glowing review of the UK insurance sector from Investors Chronicle. I would describe it as, I've spoken about this beforehand. One of the benefits of Brexit, without being too political, is the fact that the UK is looking at relaxing some of its capital requirements of what insurance companies have to keep, which will ultimately mean that they'll be able to use more of their money that's sitting on the side to do other infrastructure investments. So that's going to be positive. I think Phoenix itself is misunderstood as a business. It's got a real niche developed now, basically, and has been actively buying quite large add-ons. As a result of that, though, it's basically been buying some of those add-ons in part stock. And then, the likes of Swiss Re and Aberdeen, they've been selling down fairly large chunks, which has been putting some pressure on the share price. That's almost all done now, with the exception of about 10% left from Aberdeen. And yeah, I just basically think it's an 8% yielding stock, which kind of explains the month-on-month fall, because they went ex-dividend. And basically, I think it deserves your attention. It's like a FTSE 100 company no one's ever heard of. But in general, I think, again, there's a lot of strong insurers in the UK at the moment. I have positions in Phoenix, Aviva, and Legal & General, but Phoenix is the only one that makes the top 10. Genius Sports, I'm sitting on a pretty red amount here, like about 50% down on Genius. I was prepared to cut my losses at an investor day at the end of January. However, I was very pleasantly surprised. Although it is from a SPAC, it's a little bit different because they have a very strong European business, which is basically subsidizing their US expansion at the moment. So I was very happy with what I saw, and continue to be happy to actually hold this. And I will be looking to buy some more, just as I think it's a good long-term hold. Huntington. So this is now my third or fourth time in Huntington. It's been relatively profitable for me. I'm almost surprised how much money I've made from HBAN in the past. There's a couple of reasons why I like this bank. I know it's on the smaller side, but it's still in the middle of the S&P 500. It's still sort of, relatively big. It also is an interesting geographic exposure for me in the Midwest. I don't have anything else there at all. But actually, I think it's increasingly diversified. I think it's well run. It's actually difficult to define this stock because it's like high yielding, but growth. Somewhat defensive because it's so rounded despite its relatively small size. It basically gives you a little bit of everything. And I just like what I'm seeing, basically. They put out results a couple of weeks ago that were fractionally ahead of expectations in most areas, but broadly in line with expectations. They've just gone through a huge acquisition, which seems to have bedded in really nicely. And they're in the process of acquiring another fairly chunky acquisition as well, again, just to make themselves a bit more rounded. So I think despite its regional nature as a bank, I think it's quite diversified. Like, unless you have real fears for the geographic region, Ohio and so on, I think it's worth consideration. And I think the fact at the moment, its yield is so high, is really the result of a beaten down share price. So I'm really strongly adding as much as I can under $14. I think there's loads of margin of safety at that level. And even not, it's a plus 4% yield on a US stock, which is always nice to see. Next up, we've got Salesforce. I have a medium-sized stake in this. But I am considering adding. There was an article on Seeking Alpha suggesting it was at a 50% discount. I think it was overly bullish, if I'm honest. However, I do like Salesforce. I think they've made a bunch of smart acquisitions that will add value. It's a good solution. I've used parts of it myself, mainly Tableau. My wife she's project managers on the Salesforce CRM side. So we both have some knowledge there. But broadly speaking, I like the direction of travel, and again, I might be tempted to add a little bit to my stock. And then last but not least here, I was kind of curious actually who would add in, go get the 10th place, because there's quite a few that are very close to that. But Disney snuck in here, and honestly, this is the first time Disney's been in my top 10. And when I went to look for articles, there are so many. I don't really know where to begin. There's obviously a lot of political sensitivity at the moment in Florida. I would say the articles are mostly leaning on the bearish side at the moment. My reason for investing in Disney is a couple of reasons. So first of all, I think the EPS expectations for this year are odd and too low. The consensus EPS is about $4. I think that's not high enough. I'm aiming for about $6. Now you might say, well, Liam, where's your crystal ball? Well, first of all, I think the Q1 difference between delivery and expectations was more than 50%, so that gives some credence to that argument. Also, as well, I'm kind of just looking back at history, and although the business isn't yet up and running and it's got more cost in terms of its development, content, etc., I'm kind of looking back to sort of the last 5 years when I think the business was in similar shape, and that's kind of EPS I'm getting. It's not really at the $8 EPS. It's not kind of firing on all cylinders just yet. But I think a lot of this is just noise. I think it's an incredible brand. I think it's one of those strong long-term holds. Even if I'm off on the EPS, I'm picking up shares this week at like $114. That feels great. My average on Disney now is 122. I'm honestly fine with that. Again, even if my EPS is slightly generous, I don't think I'm being ripped off or anything. And I just think it's one of these great long-term holds that's going to be like a relatively safe stock in the consumer discretionary sphere, which at the moment I do appreciate includes the likes of Games Workshop and Hollywood Bowl. But again, my belief on those stocks is that they have, appealing businesses or moats or things that separate them basically, and mean that either they're delivering a good product or individuals just won't be keen on cancelling or not spending money in those areas. So I still like Disney. I think it has an incredibly scalable business. I think its subscriber numbers are really going, and I know like Netflix put a bit of a dark cloud across the entire industry, but Netflix always struggles in a way to scale in the same way Disney does, right? Like, although it has hits, how does it really? It can't like sell soft toys, or it doesn't benefit in the same way that say Amazon does by having sort of Prime as an all-in-one place and stuff like that. So I just think it's slightly better at scaling. So I think it's not wise to doubt the mouse. I'm not really sure where the stock is going to drop. Obviously, it's not really the flavor of the month at the moment. I think it was very unwise to get so strongly involved in Florida, frankly. So I think that's a misstep. I could actually use stronger words. I think it was a poor decision by the CEO. But there you go. But it kind of reminds me of what Buffett said, right? That sooner or later an idiot's going to be put in a company, so you best make sure it's a good, simple company. And although Disney isn't super simple, like in the same way utility is, it's a really strong company. And even if the CEO isn't an idiot and made just a misstep, I still really think this is a great long-term hold. So for me, I remain extremely bullish on Disney, and I will be adding more. There seems like there's a lot at the moment in the falling market, but that's my thinking. Anyway, that's my top 10 as it stands. Let's see what I've been buying and selling over the last couple of weeks. All right, so in reference to the title and slightly backward this week, I've just highlighted everything green, which is either tech or financials. However, I will just briefly talk about the two that aren't highlighted green. So Gamma, I think, is just a screaming buy at the moment. I think this is conservatively a £19 stock. You can see here my average this week isn't especially strong considering the stock is now closer to 12. But under £13 still feels really great. The reason here for £19 a stock, and again, I really must get around to doing a video, is I'm just looking at like the 5-year PE ratio, and if anything, actually I think it's quite obvious that the business is stronger today than it was 5 years ago. So just taking a very simple multiple of their earnings, multiplied by a 5-year average gets you to like 19-20. And again, for me, I think this should be in the low 20s as a stock. So for me, this is like an absolutely screaming buy. It reminds me of when I was picking up like National Express at close to £2. Again, it just felt like an absolutely screaming buy. If you look at the share price, you'll think it's a business in decline, but again, it's really just going places, expanding. It's very well positioned in a number of areas, and working in the industry, I feel incredibly confident that I have a good understanding of Gamma, so we're going to be buying more of that. Redrow, I'm now pretty happy with the size of my Redrow holding. It's about 1.5% of my portfolio. Feels good to have, and I'm both going to enjoy it from a yield perspective on a reasonable dividend, as well as I think there's some good capital upside here. There's a lot of like noise at the moment, everything really from the wider economy to the cladding scandal in the UK to etc. But I think house builders are well placed and will do just absolutely fine. So that's that. And now I think I'm happy with this. I don't think I'll be adding a ton to Redrow other than sort of keeping it up as my portfolio hopefully grows. In terms of that, I do recognize, by the way, that Amazon and Disney are arguably not tech. For me, however, I actually do my own grouping in my spreadsheet. So for me, I do group these as tech. The reason for that is you think about Amazon Cloud and Disney streaming, and basically the main view in terms of why they're the price that they are, and their profitability and their future and all the rest of it. That's the focus. I don't think that's especially a controversial viewpoint either. So although you can make arguments for consumer discretionary and well, I guess that's kind of both, or retail basically for Amazon, I suppose. For me, I think it's fair to group them as tech, and basically it's my spreadsheet, so I'm going to do what I want. So that's fine. In terms of the others here, I do just want to talk about a couple of them. So Disney, actually, I'm not going to spend any more time on that. I think I spoke about them enough. H-Band, likewise. T-Row. So I'm relatively new into T-Row, so I have a pretty decent price here of like 141, I think, at the moment, actually, after some buys. You'll see that they're also on my sells. So I was selling out like 146 and then buying in at like 135 again. So I've actually managed to eke out a small gain just on some trading from T-Row. I still like T-Row because I think it gives you good overall exposure to the markets. I recognize also that it's been a bit beaten up, and like its results were not stellar, although I think a lot of that had already been priced in basically. So fine. And also I just think at the moment, it's trading so far below its own averages. Not much has fundamentally changed about the business. And yeah, I do get the understanding from like free trading and robo traders and all the rest of it, but I still think it's a very well diversified business. It's huge, and it looks relatively cheap. So again, I will be continuing to buy this. As you'll see, they are on both my buys and sells. So here my average price is like 105 pounds. Which, yeah, okay, that works out like 138 or something like that. You'll see on my other, on the sells in a second, my price is like 110, so that works out like $146. So yeah, again, a marginal difference there. Kainos is an interesting one that almost nobody will have heard of. This is a very small UK IT company. However, I mean, its margins are fantastic. I think it's acquired a lot of kind of intelligence. I think it's moving in all the right directions. It's one of my aims this year to buy sort of a lot of companies that are in the process of becoming extremely profitable. So like I'd include the likes of Amcor into that. There's Cerillion, a telco billing provider basically that I know very well. These small cap companies that have the potential to multi-bag over a few years. But they're already proven and profitable, and basically Kainos is like that. I mean, you can imagine it in a few years' time being way up the FTSE 250 or even the FTSE 100. It's really on fire, basically. So to me, it's a great buying opportunity to be picking this up at under £13. My average here is about £13.50 at the moment. So that, again, I mean, obviously I'm red here, but I feel really confident in this business. I think it's great. Amcor, I'm not going to spend too much time on other than, again, yeah, so I'll be listening to the results call on the 2nd. Like what I'm seeing. So as long as there are no surprises, the last quarter surprise to the upside, smashed record EPS and earnings, revenue, basically everything. Their margins now are really starting to push through. And the last one I want to talk about is SMT. So this is Scottish Mortgage Investment Trust. Actually, my only ETF. I know it's not strictly an ETF, but that's kind of how I group it. I decided to add on to this, and it was kind of timely actually, because it was just before China mentioned it was going to go back into some supporting its economy more actively. SMT is a little bit of a proxy on China. I don't have any other Chinese stocks, so it's kind of the only play I do have, as well as sort of broader tech. It's basically a tech fund. I'm relatively late into SMT, so my average here is like just over £10. So I'm still red, to be sure, but I know other people are extremely red compared to that. I don't think SMT will ever be a huge holding for me, but I think it's nice to have kind of some technology in it that I don't have individual stocks in. When I do have bigger holdings in some of the big tech, like other than Google at the moment, none of the other big tech I hold is particularly material in my portfolio. And Google only just recently became big, right? It's not even in the top 10. If that did change, I'd have a look at exactly the holdings of SMT, see whether there was too much overlap or something like that. But for now, I'm happy, basically. If there's any overlap, it's not material in a portfolio for the holdings I have in SMT and the big tech. So yeah, but I just decided to average down a little bit, having a bit more confidence that, basically China's a bit of a coiled spring at the moment. It's obviously dealing with more of the lockdowns, and it's also suffering from things, from everything that the West is as well, right? The commodity price boom, inflation, it's got its own problems. But again, I'm sort of more optimistic than many on the state of the economy, including China's economy. So that's my rationale there. So any of these I haven't covered, feel free to ask. I try to be as transparent as possible in these things, but let's move on to the sales. Okay, so not a particularly huge list, but you can see some of these numbers are pretty big. So I'm going to start with Fever Tree. So My original plan here was basically to do a class this as a hold. I did a whole video on it basically. I'd consider buying Fever-Tree again under about 15.50 and sell them at about 22. There's definitely some upside here, and personally I'm particularly evangelical about the product. I drink this at home. I've literally got some in my cupboard. I like gin and tonic. You know, and I think their strategy is correct, right? The premiumization of the drinking market is totally a thing. Extremely strong branding, they're expanding. I think there's a lot to like about the business, but for me, they have significant execution risks. I don't think they've executed particularly well. It's kind of that like double-edged sword when the founder is still very heavily involved in the business, right? You've basically got somebody who isn't a seasoned CEO. They're making mistakes. You know, the logistics, the freight, it's like really eating into margins at the moment, kind of slowing everything down. But I am still optimistic about the business. I just think that their last update really was uninspiring. And, you know, actually, I'm glad it kind of recovered as well as it did, because it gave me a reasonably good exit. I dumped a big majority of this into Google and think I picked up a pretty good price underneath 3,300. So I'm fine taking this 1% loss basically. I have been in Fever-Tree before, so I'm still green overall on my total traded position on Fever. But to be clear, you know, again, I was down just under 1% here. But yeah, it seemed relatively expensive for the multiple, for the risks, for the hope basically. That's not completely unfounded. Like, I want to be clear. Like, I could look at this in 3 months and be like, oh damn it, I really want to buy back into the business, even though it's now 20 quid a share, right? Because everything that you've been promised could be delivered. But at the same time, I think there's just too many risks, too many quarters of kind of underwhelmingness. There's also always the hope, by the way, of the likes of Fever-Tree, right? This is about a £3 billion business, that the likes of Diageo or somebody like that just comes in and swoops them up. They're already doing partnerships with various drinking companies to sort of, you know, advertise. So that's also a possibility with the likes of Fever-Tree. So may well regret this, but honestly, even if that happens, I feel like I've made a sensible decision on the information available to me now. So, you know, you can't do anything more than that, basically. So that's my justification there. Next up, we've got Hollywood Bowl. There aren't too many people that hold this stock. It's a very small stock, you know, less than £500 million. I consider this close to £3 as a fair value, something like 290. I'd like to see the full year. But clearly it's a good business. They've kind of eked out profits across the COVID lockdown, which is incredible to me considering how much it was closed. They really cut back as much as they could. I think they've emerged from it basically a really strong business, renegotiated all their rents, simplified their menu, updated their venues, you know, kind of they start to talk about like keystone stores now, you know, when like these retail outlets start to open, you know, and look for customers basically, you know, the REITs effectively. Bowl is one of the people that they think about, and you know, it's also opening up pot stars, they call it, right? So mini golf basically, which is super fun. I think I actually achieved a pretty good sale here because it has fallen back quite a lot since. Although I put it into Gamma, which has fallen back nearly as much. So who knows? So it's basically just passing this money around a little bit. So yeah, so basically this all went into Gamma. So I guess in fairness, if I hadn't have sold this, I'd be down 10% on on bowling, and instead I'm down about 8% on Gamma from that, you know, buys. So it's all swings and roundabouts really in a falling market. But for me, yeah, I just think the bowl was much closer to fair value than Gamma is. That's my simple justification here. However, having now got to about 3,000 shares, which is about 7.5K, I think I'd like to keep a material holding in Bowl because I think it has a lot of potential. It's reintroducing its dividends this week, and you know, reading between the lines of both its competitors as well as its kind of investor relations page, you look at things like their average spend, their number of visitors. You know, a very simple calculation just puts me on the upper side of the earnings, which actually now I think I'm actually going to be about right. So you know, even though I'm ahead of market expectations, the 6-month update looks closer to me than them, put it that way. So assuming that's the case, I feel like I'm getting a really great multiple here to be buying these stocks. By the way, for me, I would absolutely consider buying shares under 240. I think that's sufficient margin of safety for a business of this quality, basically. So that's my position at the moment. T Rowe, I'm not going to spend too much time because I've already spoken about plenty. Yeah, effectively here, I just have more conviction in HBAN. That's really the crux of the matter. So I still kept in the US financials, but for me, being able to buy HBAN at 13.50 was just a really great opportunity. and I decided to action it, especially once I saw that their results, again, the acquisition is now fully digested in my opinion, and I think there's now enough regional diversification within H-band that it's not as risky as it once might have been. And again, it's supported by all the right things as well, whereas T-Row has more of some very modest existential concerns, although again, I think they're really overblown, and I think it's absolutely fine to pick up T-Row under 150, even though I sold at 146, to be super clear. And again, as is very obvious on my last buys, I still am happy to buy T-Row at current levels, even after their results, which again were disappointing, but expectedly so. Anyway, that's everything I have for today. A pretty long video by my standards, although not too bad considering we squeezed 3 weeks into 25 minutes. Thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.